It's a triple greatest bubble of all time times three in the sense that it's real estate, stocks, and other asset classes. So yeah, I do. That is my. If you're Argentine and you borrow in dollars and you print pesos, how are you going to pay the dollars back unless you have, huge trade surpluses, which they don't. So they just default. Argentina is a serial defaulter and everyone expects that. If you borrow in dollars and you print dollars, which the United States does, they're like, what's the problem? Just print the dollars and pay the money back. Well, that's true. If you print dollars, there's no reason to default on dollar debt because you actually can print the money and buy the bonds. But it doesn't mean nothing else bad happens. What about inflation or hyperinflation? What about a foreign exchange rate? The exchange rate can collapse. And these modern monetary theorists show very little understanding of the international aspects. They treat the US like a closed economy, which it's not. If it were a closed economy and we didn't have to worry about trade deficits, trade surpluses, capital flows, exchange rates, foreign credit, China owning $1 trillion of US Treasury securities, which they do. If you didn't have to worry about any of that, I think they'd probably still be wrong, but they'd have a better case. But you do. She says, well, we don't really need a bond market, US bond market. We only have a bond market as a favor to investors because it gives them a place to put their money. They say when inflation happens, raise taxes. By the way, they also say you don't need a tax system because if you can just print the money, why do you have to collect taxes? And their answer is, we collect taxes to redistribute income. Okay, well, at least they're honest. I mean, that's kind of a socialist model, but they're honest about it. If you ask the typical member of Congress to define modern monetary theory, they'll look at you funny. They've either never heard of it or they certainly don't know what it means, MMT, Acting in accordance with modern monetary theory. Whether they know it or not doesn't matter. The actual behavior, let's go back to COVID, as we talked about the debt to GDP ratio. So Trump put through a $2 trillion COVID relief package. And that was when, the Paycheck Protection Plan, that was $800 billion, and everyone got the $1,200 check. And then at the end of December, at the very end of the Trump administration, they did another $1 trillion almost. And that's when everyone got the $600 checks. And now you're up to $1,800. By the way, those checks, that is helicopter money. What the Fed does is nonsense. But when it's fiscal policy, not monetary policy, and you're handing out checks, that is helicopter money. And credit to Larry Summers for saying, you're going to get inflation out of this. Well, Biden comes into office in January 2021, and he's like, not to be outdone. He did his own COVID relief package. That was another $2 trillion. And that's when we all got the $1,400 checks. They just handed them out. And then later that year, they did the $1 trillion infrastructure package. And then, just to top it off, what did we get recently was the just under $1 trillion Green New Deal, or I call it the Green New Scam. And the baseline budget deficit, before everything I just described, the baseline budget deficit was about $1 trillion a year. So take $1 trillion for 2020, 2021, add on, $2 trillion for Trump's first package, $1 trillion for his second one, $2 trillion for Biden's first package, $1 trillion for the Green New Scam, and I think $1 trillion for infrastructure. That's $7 trillion on top of the $2 trillion baseline budget deficit. So that's $9 trillion piled on top of what was at the time about a $21 trillion national debt. So that's how we got to 30 trillion. That's how the ratio went from 106 to 131. These numbers are mind-boggling, and MMT says it doesn't matter. But it does matter, and it shows up the way I described earlier, which is it slows growth. You don't get growth. So best case for the U.S. is very slow, weak growth, which we saw from 2009 to 2019. Worst case is you throw a recession on top of that, which we're heading for, and the U.S. will be in fiscal distress. If we're on the verge of a global liquidity crisis, as revealed by the Eurodollar futures curve and the Treasury yield curve, and negative swap spreads and Treasury bill auctions with the yield of maturity below what the Fed will give you for a phone call. I mean, all those things are happening. That's hard data, and it's a very, very troubling sign. Last seen in 2008, by the way, before the Lehman Brothers meltdown. If all that's happening and the fundamental signs are also weak, which we just saw in third quarter GDP, which is based on net exports, which won't last. How are you going to drive a trade surplus with the strongest dollar in 20 years? Good luck with that. I mean, nobody can afford our stuff, and we're not buying anybody else's stuff. So with the economy going into a recession on its own, with a global liquidity crisis brewing, why on earth is the Fed raising rates at all? We're putting up inflation numbers today that are the highest in 40 years. That is correct. A little 41. Actually, it was 1981 before we saw these numbers. But I remind people, the inflation in 1981 was the end of a 10-year period of inflation. It wasn't the beginning, but it had started. I mean, in some ways it started in 1968 and it really took off in 1974, 75. So 81, these numbers, that was when Volcker finally got it under control. But you go back to 80, 70, well, between 77 and 81, so that 5-year period, the dollar lost 50% of its purchasing power, not 15, 50 in that 5-year stretch. So you were putting up numbers, 10%, 11%, 13% and higher year after year. Yeah, 1981, it was, 9 or 10, which is what they're comparing it to today. But that was on the downslope. It had been higher than that in 77, 78, and 79. So the question is this the beginning of an inflationary surge where it's going to get even worse and it is going to last 5 years? Is it different than that? But keep that in mind, because the 40-year comparison, it is correct, but that was the tail end of an even worse episode. Third quarter was a lot stronger, 2.6%. But when you dissect that, what you see is that was almost 100% driven by net exports. When was the last time the United States had positive GDP driven by net exports? Probably 1959. I mean, that's typically a drag on growth, and we've been running trade deficits forever. That meant that people were still buying U.S. goods, but we were not buying as much from other people. That's indicative of a slowdown. Consumption was weak, private investment was weak, inventories were weak. Those are the real drivers of the economy, and they were all weak. So, okay, net exports, that's not sustainable. So I would look for a recession, a more severe recession to begin in the fourth quarter. That's one, combined with Fed tightening, interest rate hikes, balance sheet reductions, et cetera. That's one whole vector, and I wouldn't put any weight on a low unemployment rate. It ignores labor force participation rate, which is awful. It's down around 62% versus 70% in the year 2000. But beyond that, unemployment is a lagging indicator. Unemployment goes up after a recession begins. Employers are very reluctant to lay off employees. You got to pay severance. It's expensive to recruit and hire them back and train them. So you pretty much wait until the recession has already started, and you can, all right, I got to lay some people off. So it's not a leading indicator, it's a lagging indicator. So the Fed is behind the curve. There's a brewing global liquidity crisis, a global financial crisis that's different from a recession. It's financial panics and recessions are two different things. They can come separately. In 1998, we had a financial panic, but there was no recession. In 1990, we had a recession, but there was no financial panic. In 2008, we had both. They can come together. It looks like they might be coming together again. This is revealed in inverted yield curves. Major dealers are bidding at auction for treasury bills. Jeremy Grantham actually did do a 100-year time series and looked at bubbles all over the world, 1929 US, 1989 Japan, 2000 dot-com stocks, and many others. And he said he's never seen anything like it. It's a triple greatest bubble of all time times 3 in the sense that it's real estate, stocks, and other asset classes. So